A $50 billion shock may be about to hit the silver market, not because of speculation, but because of rules. Allegedly legal rules that could force massive pension funds to buy physical silver at the worst possible moment. A wild story is making the rounds. The claim is simple and explosive. A collapse in the gold-to-silver ratio may have triggered automatic buying from pension funds, potentially flooding the physical silver market with tens of billions of dollars. A process that legally forces these gigantic funds to dump gold and panic buy physical silver. The numbers being thrown around are mind-boggling. A $50 billion tidal wave of cash, all programmed to chase one of the smallest, tightest physical markets on the entire planet. If it's true, it's not just a massive profit opportunity. It's a catastrophic trap for anyone unprepared. But that brings us to the real question. Is it actually true? Today we're putting this explosive theory under the microscope. We're going to peel back the layers of hype, check the sensational claims against hard data, and separate the facts from the fiction. We'll expose the real forces that are tightening the silver market to its breaking point, and these forces might be even more powerful than some rumored pension fund panic. What's happening in Shanghai, London, and New York right now is the real story. And by the end of this, you'll understand the opportunity and the very real dangers ahead. A financial storm is brewing, and get this, it's supposedly legally required. That's the claim. The gold-to-silver ratio has allegedly smashed a critical line in the sand, triggering a mandatory rebalancing for major pension funds. They say a $50 billion tidal wave is about to crash into the physical silver market starting as soon as next week. We are going to look at the evidence, or the lack of it, and find out what's really driving the unprecedented moves in silver. The theory claims that pension funds are not choosing to buy silver. They are being forced to. According to the narrative, automated rules tied to the gold-to-silver ratio may have triggered mandatory rebalancing into physical silver. The theory has three parts: a trigger, a mechanism, and a massive consequence. First, the trigger, the gold-to-silver ratio. This is just the price of gold divided by the price of silver, how many ounces of silver it takes to buy 1 ounce of gold. For centuries, it's been a barometer for financial stress. Historically, the ratio was around 15 to 1. More recently, 60 or 75 to 1 has been common. When the ratio spikes to 90 or 100 to 1, it's a huge signal that silver is undervalued compared to gold. When it compresses, it means silver is gaining strength fast. The theory we're digging into hangs on one critical number: a collapse of this ratio to below 60 to 1. The story goes that in late 2025, the ratio didn't just dip below this level, it shattered it, signaling a violent shift in the precious metals market. That leads to part two, the mechanism. It's been called the institutional mandatory rebalance. The idea is that huge pension funds have algorithmic rules hard-coded into their investment charters. One of these rules, the theory claims, is tied directly to the gold-to-silver ratio. Traders sometimes call it the 80-60 rule. The logic is simple. When the ratio is above 80, the algorithm sees silver as cheap and starts buying. But when the ratio falls below 60, it triggers a much more aggressive action, a mandatory rebalance out of gold and into the outperforming silver. According to the videos and analyses floating around, this isn't a guideline. It's a legal requirement to keep their portfolios balanced. Since silver was a top-performing asset in 2025 with a 154% gain year-to-date, these automated systems are supposedly now forced to chase that performance. And that brings us to the third most explosive part, the consequence. The number being passed around is a tidal wave of cash between $47 and $50 billion. Not a slow trickle, but a flood of buy orders supposedly queued up and ready to hit the market as soon as January 15, 2026. The people pushing this theory point to supposed regulatory filings from late 2025, claiming 16 major pension funds, quietly upped their silver positions by 340%, trying to get in front of the mandatory buying wave. To put $50 billion in perspective, you need to understand just how tiny the physical silver market is. The entire world's annual mine supply is only worth about $15 to $20 billion. A sudden $50 billion injection of cash would be like demanding 2 or 3 times the entire world's yearly production, all at once. There is just no way the market could handle that kind of demand without a historic price explosion. The theory concludes this is an unstoppable force about to meet the immovable object of physical scarcity. But here's where things get dangerous. If this story is wrong, millions of investors are positioning themselves for an event that may never happen. And when expectations collapse, markets punish late believers brutally. A story that perfect always demands a closer look. The financial world is full of compelling stories, but the ones that actually make you money are built on facts. So let's put this theory to the test. This is where the story gets a lot more interesting. First up, that trigger, the gold to silver ratio. The whole theory depends on the ratio collapsing below 60 to 1 in late 2025. But when we look at the actual market data, a different picture emerges. As of December 26, 2025, the ratio is trading right around 60. It hasn't sustained a dramatic crash below that level. In fact, data from earlier in December showed the ratio at 74. And right there, we hit our first problem. The ratio is definitely compressing, which shows silver's strength, but the catastrophic collapse that supposedly set off the alarms hasn't happened the way the story claims. The premise is already on shaky ground. Next, let's look at the core mechanism, that institutional mandatory rebalance. The theory says it's a hard-coded legal requirement. But after digging through SEC filings and mainstream financial news from Bloomberg, Reuters, and the Wall Street Journal, there's simply no public confirmation of these widespread automated clauses in pension fund charters. There are no credible sources confirming a systemic, ratio-driven rule that forces a rotation from gold to silver. Pension funds do rebalance, of course, but those decisions are typically made by investment committees, maybe quarterly or annually, based on a whole range of factors, not a single rigid trigger like the 80-60 rule. The 80-60 rule seems to be more of a piece of trading lore, a useful guideline for you and me, not a binding constraint on a multi-trillion-dollar pension system. What we do find is something far more interesting. On December 11, 2025, India's pension regulator, PFRDA, officially changed its rules. It will now allow private pension funds in India to invest in gold and silver ETFs for the first time. Some estimates suggest this could unlock between $1 billion and $1.7 billion in new demand. On top of that, we are seeing big institutions everywhere talking about moving away from the old 60-40 stock and bond portfolio toward models that include a real allocation to precious metals. This isn't a panic. It's a slow, strategic, and massive repricing of risk. It's a deliberate shift toward hard assets. But it's not the automated panic the theory describes. This brings us to that sensational 50 billion number and the supposed 340% increase in silver positions. Just like the mandatory rebalance rule, there is no verifiable public evidence to back this up. It appears to be pure speculation. So if the pension fund story is mostly hype, does that mean the silver story is a lie? Not at all. It just means the real story is being buried. The silver market is under extreme stress, but the reasons are more fundamental, more tangible, and maybe even more bullish for the long run. The panic is real, but it's not coming from a pension fund algorithm. It's coming from the physical market itself. While the pension fund theory doesn't hold up, it would be a huge mistake to ignore the urgency. The silver market is not healthy. It's flashing bright red warning signs of stress, dislocation, and flat-out scarcity. This is about the very real pressures that are threatening to break the market wide open. The most glaring sign is the growing disconnect between the price of paper silver and physical silver. In a normal market, if silver is cheaper in New York than in Shanghai, traders buy it in New York and sell it in Shanghai, and the price gap closes. That mechanism is now breaking down. As of late December 2025, the price on the Shanghai Gold Exchange, SGE, has seen a massive premium. On December 24th, reports showed that physical silver in Shanghai was trading at a premium of over 8 per ounce compared to the COMEX futures price. Some sources reported Shanghai physical prices hitting around $78.49 per ounce, while the Western paper price was closer to $72. This isn't a glitch. This is the market screaming that there is a desperate scramble for actual deliverable metal in the East. China is the world's biggest silver consumer, thanks to its massive industrial sector making solar panels, electronics, and EVs. When the physical price in Shanghai decouples like this from the paper price in the West, it means buyers in China don't believe they can get the metal they need at the price quoted on a screen in New York. They want the metal, not a paper promise, and they are willing to pay up for it. This is a classic sign of a market in the early stages of a physical squeeze. This scarcity is very real. It's the result of a severe and ongoing supply deficit. For 5 straight years, the world has used more silver than it has produced. According to data from the Silver Institute, the market is on track for another big deficit in 2025. Cumulatively, since 2021, the market has run a supply shortfall of nearly 820 million ounces. Think about what that means. Annual silver demand is around 1.2 billion ounces, but miners only pull about 835 million ounces out of the ground. That massive gap has been draining global inventories year after year. Vaults in London, New York, and Shanghai have been steadily depleted. This deficit is being fueled by 2 powerful engines. First is industrial demand, which now makes up over half of all silver consumption. Silver is an indispensable strategic commodity. You can't build high-efficiency solar panels, 5G networks, or AI data centers without it. In a sign of its importance, the U.S. government has even designated silver as a critical mineral, vital for national security. The second engine is investment demand. With inflation sticking around and geopolitical tensions rising, investors are waking up to silver's role as real money. Silver-backed ETFs saw net inflows of around 187 million ounces by early November 2025. This collision of surging industrial demand and resurgent investment demand, all happening against a backdrop of a chronic supply shortage, is the real force shaking this market. It's what makes the week between Christmas and New Year's, sometimes called Ghost Week, so dangerous. With many Western traders on holiday, market liquidity dries up. It's a vacuum where any large order can cause a violent price move, what some call the widowmaker. It's a time when anything can happen. Okay, so we've torn apart the sensational theory and uncovered the real fundamental truths shaking the silver market. The noise about a $50 billion pension fund panic is a distraction from the much bigger crisis, a structural supply deficit crashing into unstoppable demand. The question is, how do you play this? How do you sidestep the trap and position yourself for the opportunity? The answer lies in a strategy based on facts, not hype. First, you have to separate fact from fiction. The main takeaway here is that while the pension fund story is mostly unsubstantiated, its conclusion, that the silver market is under extreme upward pressure, is absolutely correct. Let's quickly recap what we know for a fact versus what's just speculation. Fact: the silver market is in a multi-year supply deficit. For 5 years, demand has outstripped supply, draining inventories. Speculation: a mandatory automated $50 billion pension fund buy-up is about to happen. There's no public evidence for this. Fact: there's a major price disconnect between physical silver in Asia and paper silver in the West. The Shanghai premium is real, and it signals a scramble for metal. Speculation: Silver will hit $100 Oz next week. While many are bullish, these short-term targets are tied to the unproven theory. Fact: industrial demand for silver is locked into long-term growth trends like green energy and AI. Fact: big money is strategically and slowly increasing its allocation to hard assets, like the recent rule change in India. The real opportunity isn't in trying to front-run a mythical pension fund wave. It's in recognizing that the fundamental case for silver is stronger than it's been in decades. The trap is getting swept up in the short-term hype. Chasing wild price spikes fueled by rumors is how you get wiped out by volatility. The solution is to think like a long-term investor, not a short-term gambler. Your strategy should be based on the fundamentals we've confirmed: the supply deficit, the industrial demand, and silver's role as real money in an era of currency debasement. So, what does that look like in practice? It means seeing price pullbacks not as a failure, but as a buying opportunity. The road up will be volatile. There will be sharp, painful dips. But as long as the physical market stays tight, and the premiums in Shanghai tell us it is, those pullbacks are likely just corrections. It also means watching the right signals. Instead of looking for headlines about the pension fund wave, watch the inventory levels at the COMEX and LBMA vaults. Watch the physical premiums. Watch the supply and demand reports from the Silver Institute. Those are the vital signs of the real market. Credible price forecasts reflect this bullish but volatile outlook. While hype calls for $100 silver tomorrow, more measured analyses see a strong upward trend. Price predictions for 2026 range widely from the mid-40s to the $80, $90 range, or even higher if the supply crunch gets worse. The consensus is clear: the direction is up, but the path will be a roller coaster. A smart strategy might involve dollar-cost averaging, building a position over time to smooth out the ride. It means owning the physical metal or a fully backed physical ETF, taking yourself out of the leveraged paper game. The noise and fury in the coming weeks will test your conviction. The key is to anchor your strategy to the undeniable facts. The great silver repricing is happening, but it's a story of physical scarcity, not a phantom pension fund mandate. Understanding that difference is how you survive the storm and capitalize on the opportunity it presents. The $50 billion pension fund story may be a myth, but the stress in the silver market is not. The real signal isn't in rumors, it's in physical shortages, rising premiums, and years of supply deficits. This market isn't moving because of panic. It's moving because reality is catching up. Those chasing headlines will get shaken out. Those watching the fundamentals will understand what this volatility really is: the early stages of a structural repricing driven by supply and demand.